Okay, awesome. Well, let me go ahead and get my PowerPoint here started. Oh, well, that is not what I wanted it to look like at all. Okay, hold on. Let me unplug my other screen. Okay, how does that look to you? Does it look okay? Can you see my slides?
Looks brilliant. Beautiful.
Perfect. Okay, awesome. Thank you. Okay, so I am talking today about specifically about 2024 home buying. So this is not my normal how to buy a house webinar. A lot of times I go through like the 10 steps of the home buying process and all of that, but we're not doing any of that today. We're specifically looking at like what the market's doing and what we think it's going to do for 2024. Okay, can I go to the next slide? Okay, so here is my little agenda of what we're going to be looking on. So what I think is going to happen in the 2024 real estate market, current interest rates and future projections, the whole election year nonsense and what it could mean for us. I'll talk about some special loan programs and grant opportunities, bidding wars and if we should expect them, and then also buying with refinancing in mind, because that's really important right now. So first, I want to introduce myself very quickly. So my name's Sarah Ward. I have been a real estate agent for 10 years. I work with buyers, sellers, and investors throughout San Diego. And I also invest in real estate myself. So I'm not the average real estate agent that just works with clients. Like I also practice what I preach. So right now I own 12 units, some here in San Diego, some out of state, and I buy and sell regularly. So like I intimately understand the emotion and stress that comes with home buying, whether it's your dream home or an investment property. I totally understand what my clients feel. And so I feel like I can help them do a really good job and be more empathetic and like get the process done as streamlined as possible because I'm in it all the time for myself as well. Okay, I'm going to dive right in, but you guys stop me at any time if you have any questions. Feel free to unmute, type in the chat, whatever you want. I'm just going to roll through and then you guys let me know your questions as we go. So let's start about what I think is going to go on in 2024. Obviously, we're in January right now, so I kind of wanted to start at what happened in 2023. So interest rates peaked at 8% in October of 2023. So you can see this is my little chart ending in November of 2023. So you can see we got up to the peak here right in October at about 8%. 2023 was a really weird year for listing agents and sellers because some houses we'd put on the market and they'd immediately sell and have a bunch of offers. And then some properties would sit and we never really knew like which it was going to be for a house. So as like a listing agent, I'd sit with a seller and say, we need to be prepared for a month on the market, but we could sell in a week. We're not really sure. And then throughout 2023, prices did stay relatively consistent. A lot of people thought prices would drop because interest rates went up, and that just never manifested. They really stayed consistent throughout the year. But many buyers dropped out because even though prices stayed the same with interest rates going up, your monthly payment was so much higher, and I'll illustrate that later, that buyers just said, hey, it's too expensive. I can't make it happen unless prices go down or interest rates go down. And then the other major issue we saw is a lot of people decided not to sell because they didn't want to lose their 3% interest rate. And like, who can blame them? The issue was it just put a stop on supply. So we didn't have our regular motion of, you know, someone gets pregnant and they decide to buy a house, or people get married and they decide to buy a house, or like, you know, the kids go off to college, so the parents sell and downsize. We just lost that kind of consistent engine. So sitting in 2024, we have pent up demand for buyers, and we really do have it for sellers as well. Kind of end of 2022 and 2023, we really only saw death sales, divorce sales, some downsizing sales, and a few moving out of state sales. So there weren't just the normal upgraders happening as much. Everybody kind of just held. So this is a look at the number of new listings. Yikes, it's always a scary number, the number of new listings, just as a real estate agent, because in San Diego, there's over 10,000 real estate agents. And you look at data like this, where you see last month, December of 2023, only 679 homes came up for sale in the entire month in the whole county. This is the county of San Diego. And 453 condo townhomes. So you can see we were kind of consistent, and then we hit our little holiday lull. We usually get a holiday lull, and just very, very little supply. You can see the year over year change in every single category is down until the end of the month or the end of the year on attached condos, townhomes. So we spent 2023 with a massive lack of inventory, even worse than our low inventory previous years. Now we're looking at the median home price here. So you can see in January of 2023, 1 year ago, our median was about $850. And now at the end of the year, we're about $950 median home price. And it kind of was consistent throughout the year. Like I said, you know, 900, 940, 950, 955. It got up to $1 million at one point, down, back up. So it's been fairly consistent throughout the year compared to past years. But we are ending higher. We did start to see a little bit of increase in market value towards the end of the year. Days on market, you can see in January, February, that's when the interest rates really started to come up. And remember, it was like rainy and cold every day. That has a huge effect on San Diego real estate. So we saw houses sitting for a very long period of time in early 2023, but all of these numbers are a little bit high compared to what we normally see. The interesting thing I always like people to know about days on market is that this is an average. So if you see December of 2023 was an average of 31 days on market, that means half the houses sold in less than 31 days, and then half the houses sold for more than 31 days. So we are really seeing a lot of dichotomy throughout 2023, causing this average to be a little higher, because good houses still sold in about a week with multiple offers, but other houses sat for 2, 3, 4 months, causing our average to shift up a little bit, even though things were still selling quickly. Okay, percent of list price received. This is one of my favorite statistics. And it's a common one I look at for zip code data as well. So in this chart here, I know it's so much data, but I just like to, let everybody know what's going on. In this chart, we're looking at the entire county of San Diego, but I can also pull it for specific zip codes. And what this tells us is, did houses sell for over asking price? So if something sold for 100%, that means it sold exactly for asking price. Over 100% would be more than asking, and under 100% would be less than asking. So we saw houses for once in our lives selling below asking price. Sellers were actually taking offers below their asking price. Now, we did see some competitive times, and again, if a lot of houses sell quickly, the summer is always a little more active, the sun came out, all of these are different factors on why we see these little hiccups. But you can look at the 12-month average, and we were at less than 100%. So for the year, we saw more houses selling at or below asking than over. It was kind of a nice relief, too, for all of us that were, buying or working with buyers, to not always be crazy over asking. Now we're moving into 2024, and buyers are absolutely back. So if you take a look, remember how I said that we peaked in October of 2022 at 8%? That's the peak of the blue line here. By the time we reached December and before the holidays, between Thanksgiving and Christmas time, we really saw this drastic drop right here. By the way, the blue line's a 30-year fixed and the green line's a 15-year fixed. So I always look at the blue line because that's what most people are buying with. People usually just refi into 15 years. They don't usually buy with them, at least not in San Diego because our prices are so high. So that really big drop right here caused buyers to say, maybe it's time I jump back in. Rates are becoming more reasonable. They're down below 7%, and maybe it's time to jump in. I always talk to my clients about buying during the holidays. If you're thinking about buying in the spring, it's cool to start in November, December, January, because we just see less buyers because people are busy. They're traveling, they have family staying with them. And so it's a good time to start to jump into the market. And that's really what happened is rates came down and people jumped in. So we saw more buyers entering the market. We're starting to see, and we have seen for about a month now, very busy open houses, and homes are receiving multiple offers. And our little holiday lull was extremely minimal this year. So moving into January, we're just kind of moving again, in the real estate industry. We're seeing buyers back, busy open houses, multiple offers, homes selling. Things are still sitting. We haven't reached the point where everything's selling super quickly. For example, I have buyers right now in Chula Vista looking for a house, a single family house. Everything is selling immediately. Like immediately, everything's selling. Multiple offers, tons of offers. But then I have another client looking for a condo in Carlsbad area, and things have been sitting for 30 days and are just we come in, we're slow, we write under asking. So it really just depends on the area. It's not to the point yet where everything's being bid up and everything's selling immediately. But watching the market in some of these zip codes and talking to other professionals in the industry, we are all feeling like 2021 is coming again. So what happened in 2021? A lot of things, but we saw a halt in the real estate market when the pandemic broke out, followed by everybody working from home, followed by everyone wanting a bigger space, a home office, a bigger backyard, and all of a sudden, everybody wanted to buy a house. So we had a ton of buyers, multiple offers, every house selling for more than the last. But I want to look at the specific data that we were just looking at. So in 2021, our new listings per month were 2,300 detached and like 1,300 attached on average. Compared to 2023, we're at like half that, So our supply in 2021 was low. Our supply now is massively low, like the lowest we've ever seen. And somehow every year I say this and every year supply gets lower. I don't even know how it's possible. Median sales price, guy, look at the difference, right? From 2021, just 2 years, and our median price has gone from 715 to 932 or so. And then days on market, 22 days versus 31 and 28. So things in 2021 were moving. If you didn't see the house the first weekend, you had no chance. There was no like, oh, maybe it'll sit for a week. Very rarely happened. And then you can see our percent of list price received, both significantly over 100%. Everything was selling for more than asking price. And when it all started in 2020, the little surge in buyer demand, I was advising people that if you go about 5% above asking, you'd probably get the house. But then in 2021, that wasn't working anymore. Houses were selling sometimes for 10 or 15% above asking price. And it got out of control. So what's going to happen in 2024? Well, we're assuming that interest rates should continue to drop, making way for buyers who purchased in 2023 to refinance and drop their payment. So there's a lot of different opinions on this, but the consensus is people think we'll be under 6% by the end of the year. So back in the 5% range. And I really think if we get to an average of like 5.5, 5.25, it's going to become more of an equilibrium. So my buyers who have a 7.5% or 8% interest, which I have a handful of people who bought a house and are sitting on that, they're going to be ready to do a refinance very soon and drop their payment down. We are, like I said, seeing buyers return to the market and causing demand to surge. And we're hopeful that rates in the 5% will become a new normal and homeowners will be more open to selling rather than just holding on to houses because of their interest rate. Because that's a common thing. You know, I talk to a lot of people like, hey, are you thinking about buying or selling? And I get a lot, hey, I have an interest rate at 3.25. Like, I'm not selling this house ever. But at a certain point, you know, people need more space. They have a baby, you know, they move jobs, and eventually they will just sell their house because they have to and they can't take it anymore. So hopefully those 5% interest rates will become the new normal and we'll get back to like a regular market. The elephant in the room, though, lower rates equals more demand equals higher prices. So what's the ultimate prediction for 2024? If rates go down substantially, prices will probably go up as a result. Because as your mortgage affordability gets better, more people are going to be able to afford a house. They're going to jump in the market and they're going to start to bid prices up. So that's my little summary of what I'm expecting for 2024. What do you guys think? Do you have any questions or comments so far?
Yeah. Do you have any info on multifamily? I'm currently in the market for, like a fourplex or some scenario like that.
Yeah, absolutely. So when we're looking at multifamily, there's two types, right? 2 to 4 units is considered residential, and then 5+ units is considered commercial. So all the data we looked at is for residential, and that would go with residential multifamily as well, these 2 to 4 unit properties. So what I'm seeing is the same kind of thing where we are seeing a surge in investor demand. We're also seeing on multifamily properties more investors jumping in because of the ADU laws. So there's a lot more ability to buy a 2-unit property and then add a unit or two. So that's caused a little like of our not mom and pop investors, just the next level up of people who want to increase the value of a property. But then one of the things I was going to mention is we are seeing a return of conventional low down payment 2 to 4 unit properties, 2 to 4 unit property loans. So one of the strategies I talk about a lot is using a low down payment loan and living in one of the units and then renting out the others. And the lender will actually take the rents from the other units, the market rent or the actual rents, 75% of that, and add it to your monthly income so you can qualify for more. So number one, we're seeing that happen more and more. FHA does it, but now we're seeing it more with Fannie and Freddie as well. And it depends on the situation. So I was just talking with my loan officer about this on if 5% is doable. And she says it's a kind of a case by case. It depends on the purchase price because we have loan limits on based on per unit. So like a loan limit on a 1 unit versus 2 unit versus 3 unit versus 4 unit. So it depends on the price and how many units is what kind of loan. It gets very complicated. We can talk about this for hours. But there's more opportunity for that low down payment because in 2020, when COVID happened, they pulled so many loan programs, and that was one that they pulled. So my clients that bought a duplex in 2021 had to put 15% down. Their only options were FHA 3.5%, regular 20%, or 15%. There was no 5% and no 10% product. But we can get a 10% product now, and we can sometimes get a 5% product. So there's a lot of good opportunities for people who want to live in one and rent out the other. But just like everything else, investors, you know, if they have a 3% interest rate because they refied to the lowest available and they're getting good rents, they're not selling. So we still are having a lack of supply in the 2 to 4 unit as well. You're muted.
And that's outside of a DSCR loan, correct?
Yes, absolutely. I'm going to talk about DSCR loans coming up in a minute. But that would, so a DSCR loan is non-owner occupied versus an owner occupied. So I'll talk about that when we get to the loan section. I have a bunch on it. Okay, cool. All right. So let's talk a little bit about interest rates and what we think they're going to do. So the first thing I always like to point out, because not everybody knows this, is the Federal Reserve has nothing to do with mortgage rates. So when we get headlines that the Fed raised rates, they are not raising mortgage rates or car loan rates. They're raising what's called the federal funds rate. And I have the definition right here. So it's the rate banks charge each other for very short-term loans. It's not mortgage interest rates, but it has a trickle-down effect. So if the Fed raises rates, mortgage rates fluctuate based on that because the bond market and all of that, it gets complicated and financial. We don't need to go into it, but you just need to be aware that when they say, hey, Jerome Powell's, he's increasing rates by a quarter point, that's not mortgage rates, that's the federal funds rate. But mortgage rates could follow. So what's the point of the Federal Reserve? Just so people know, their whole job is to control inflation. So inflation goes up, inflation goes down, and the Federal Reserve has to make little modifications to our market to help it stay level. And they really only have one thing they can adjust, and that's that federal funds rate. So we saw insane inflation with the stimulus checks from the pandemic. Inflation was getting out of control, and the Fed had to step in and do something. So you can see right here, my second bullet point, they really wanted to just stop consumer spending. And that's what raising the federal funds rate does, because it trickles down to mortgage rates and it trickles down to car payment loan rates. People stop taking on debt. They stop spending money. They don't buy a new car. They don't buy a new house. And that's exactly what they wanted. They didn't want people to buy new things, so that way money is not flying through our economy. I have the little chart here on all the increases. You can see starting in 2022, in March, they consistently raised it every single month until June of 2023. And then they only raised it one more time so far. So at the end of 2023, the Fed said, hey, what we've done is working. Inflation's slowing down. And so now they're talking about starting to lower that federal funds rate, which should start to encourage consumer spending and consumer borrowing again. Now, I don't like to get, political or anything like that, or hot if I can avoid it. But having gone to business school, there's a formula for inflation, and the formula has been changed. And that's something that people aren't really talking about. So when the Fed says, oh, inflation's under control, they are looking at a new definition of inflation. So in this whole 2022-2023 debacle of inflation, they changed the formula to remove gas prices and I think groceries. I can't remember. There's two things that they removed from the formula when they calculate inflation. So now our new inflation calculation is like modified. We all know what happened with gas prices. They went way up as well. So we think inflation's more in control, but also there's this other like background factor of, is it only in control because they changed the formula? We'll just have to wait and see. So as they lower rates right now, if all of a sudden home prices and inflation start getting out of control again, I would expect the Fed to stop us and raise rates again. So it'll be kind of interesting to see if lowering the rates pushes inflation or if we can kind of stay steady. Here's the ramifications of inflation. Like I said, the Fed wanted to put a stop on homes being bid up and market value increasing month after month. So if you weren't in the market in 2021, here's what happened. Every house that sold created a new comp. A house would list at market value, they'd receive multiple offers, get bid up, and then sell for a new market value. So for example, they'd list the house for $700,000. They'd get 15 offers and accept one at $750,000. they'd go sold. Then the next house would list, the one down the street, and they'd be like, okay, we're going to list for 750 because that's what the other one sold for. So they'd list for 750, get 15 offers, sell for 785. Then the next house would list at 785, and it would just continue on and on and on. So there's this weird thing that would happen to buyers where we'd put an offer in on a house and get bid out, and the house goes pending, but you don't know what the final price is until it goes sold, unless you were one of the offers. Then your agent could potentially find out what the price was. So now you're one of the 7 people that know what it's going to sell for, and you have to quickly find another house before it goes sold so the new comp doesn't come out, because any other houses will be listed higher once that house sells. And it was a very bizarre thing, but it caused this little like rush of people to be like, oh my God, I need to buy a house. Also, like a good sample of this is Rancho Bernardo. I can't remember if it was 92127 or 92128. Home prices went up over 30% in 2021 alone. So they went up by a third, which is insane. Another little factor that happened is knowing that the Fed would start to raise rates lit a fire under buyers because everybody wanted to lock in that low rate before it wasn't available anymore. So that caused even more buyers in the market on top of just our regular I need a house buyers. And we're still seeing the ramifications of this. I would say San Diego home prices have pretty much doubled since 2020. I just showed a house today that's $1.7 million, and I almost fell over when I heard the list price. Like, it was just a basic house, and it's in Carlsbad in an HOA, and it's 3 bedrooms, and it's sold for, or it's listed for 1.7, and they have multiple offers. And that's crazy to me, but that's what's happening. So interest rates, they're starting to drop down. Our 30-year fixes are now in the 6s. We're seeing, now there's a lot of factors that dictate if you're getting a good interest rate or not, or what your interest rate is going to be. So Gabe, to your point, multifamily. If you have multiple units, your interest rate will be higher than a single family house. If you're going to live in the house, that's an owner-occupied loan, lower interest rate, non-owner-occupied, higher interest rate. So our average right now is 6.69 for a 30-year fixed. I would say a well-qualified buyer could probably get a 6.5% interest rate right now if they have a good credit score on a single-family house they're going to live in. FHA rates are 6.5. VA rates are 5.75-ish. And for my investor clients, we're still in the 7s. I would say multifamily, you could be at 7.5, something like that. So they're not super low, but they're moving downward, and they're a little easier to swallow now. So to finish my thought on where we think rates are going. So Jerome Powell and the Federal Reserve have said either they're going to raise or lower rates 3 times this year or 6 times this year. I've heard conflicting things. I thought he said 6, but all the articles are saying he said 3. So we should start to see rates continuing in a downward trajectory. And all the loan officers I've talked to are thinking that we're going to end the year closer to 5.5% average or 5.75. So the final question is, what did we learn over the last, let's see, 15 years? Well, when the housing crash happened in 2007, 2008, and then the Obama administration came in, we were in a recession, right? And they wanted to pull us out of the recession. And one way to do that is to get people to spend money. And a way to do that is to lower interest rates, like we've been talking about. So interest rates were kind of at, 5%, 4.5%. And they got down so low, as we all know, some people have 15-year mortgages at 2.5%, which is crazy. And I think seeing interest rates go up and what it did to our bond market and what it did to our banks, I think that the lesson learned here is interest rates should never have been 3%. It's just too low for our economy to function. And I don't think we'll see them for a very long time. So I don't know if the new normal is going to be in the 5% range or the 4% range. But for people that are trying to hold out, I had a girl message me the other day that she's holding out for 2% interest rates. And I didn't want to like laugh at her because that's so rude, but I just don't think that's in the cards for us. I think that it's fresh enough in our minds that people are not going to, the Fed's not going to lower them that much. So that's kind of my projection is I think we'll end up in the 5% range or 4% range as our new normal. This is my little mortgage affordability. So this is two different mortgages, and it just shows you like what rates did. I always like to let people know like what exactly rates did. So if you're buying a house for $1 million with 20% down, over here on mortgage option 1, I have 4% interest rate. And that gives us a PITI. We'll talk about what that means at 4,800. But when we had interest rates go up to 7.5%, now all of a sudden our PITI for the same house is 6,500, 6,600. So our payment difference there, 1,774 purely from interest rates. Crazy. So that's the effect we've seen. And the opposite is also happening. So if rates do come back down in the 4% range, you can see that drop in payment that people are going to be able to see. And we're going to talk about refinancing, and like this is what you could expect if you buy at 7.5% and then rates drop to 4%, is to drop your payment 1,700. Okay. I'm going to talk about some real estate myths here. So my biggest real estate myth is the dream home myth. And I talk about this a lot because I always like to get it in people's heads. Some people, lots of people say they're not going to buy a house until they can afford their dream home. And there's a lot of people sitting on the sidelines because their dream home is unattainable and they're just renting because they can't buy what they want. So I like to talk about how regular people build wealth with real estate. You buy a property to live in, you slowly add upgrades and sweat equity. Home values go up over 2+ years. You sell the current property with a tax-free gain, and you use the profits as a down payment on a bigger and better house. And then you repeat it. The 2-year tax-free gain. Remember how I just said that you can sell the property and get a tax-free gain if you live in it for 2 years is the key. So I'm not an accountant, so I always like to put in the tax law because like, again, you guys talk to your accountant before you get any accounting advice. 2-year tax-free gain. You have to live in the house for 2 of the last 5 years, which is kind of cool for people like Gabe and me who have rental properties. Because if you live in it for 2 years, rent it for 2 years, you can still sell it and take your tax-free gain as long as you've lived in it 2 of the last 5 years. That's cool. If you're single, you get $250,000 tax-free. If you're married or 2 people, you get $500,000 tax-free. And so this is why people move up, right? They buy a house, they fix it up, it goes up in value, they sell the house, and then they can move up into something else using the profits as their next down payment. So I'm actually doing this myself. I am on step number 4 right now in my own house. I have a property I've lived in. I bought it in 2018, lived there the whole time, and it has doubled in value. And so now I'm able to buy a bigger house, actually my dream house, which is very exciting. And I'm going to be able to pay for it with the tax-free gain I have on the house that I've been living in since 2018. Versus some of my friends that are my same age who I begged to buy a house in 2018. And they said, well, we can only afford a condo, so we're not going to buy anything. But if you look back at the data we looked at the beginning, if they would have purchased a house or a condo in 2018, it would have at least doubled in value now, and they'd be ready for their dream house instead of continuing to rent. So it's just something to be aware of. You know, all boats rise. San Diego, we're an appreciation market here. I talk with my investor clients about cash flow markets versus appreciation markets, and we are such an appreciation market. We see home prices go up, and you might as well take advantage of it, right? Prices are going up whether you buy or not, and rents are too. So don't get caught up in the dream home myth, right? Like stepping stones. That's what I always say. Once you're in the market, then you have options. If you buy a condo, you can rent it, you can sell it, you can continue to live in it. You have options. So you can even do it with an FHA loan. We're going to talk about FHA loans, but they're 3.5% down. So let's say you buy one for 400,000, which is tight right now. So we'll use the 400,000 as an example, but honestly, your budget needs to be 550 at this point. Over the next 2 years, let's say you spend 25, 35,000 remodeling, doing flooring, a new kitchen, a new bathroom. You start to pay the loan down because you're making your payments every month. Then you sell it for a profit. Maybe you can make $475, $75,000 in profit. Walk away with tax-free cash. My scenario, you have about 70,000 tax-free. And then you move on and use that as the down payment on your next bigger and better property. And you just keep rolling. And this is what people do. You repeat over time. Here's my San Diego home prices over time. And I am a little dated here. This only goes through 2022, but I always like to show this chart. We were really flat for a while here, but this was when interest rates were super high. So that's a different story. But you can see in 2000, we just slowly go up over time, slowly go up over time. Then we got pretty hot. And then we all know 2007, 2008, a huge crash. And people thought the world was ending and we would never recover. But like, look where we're at now, and prices have continued to go up. So historically in San Diego, home prices double every 10 to 11 years on average, right? Sometimes it's 20 years, sometimes it's 5 years like we just saw. So on average, every 10 to 11 years. And as you're owning, you're also paying down the mortgage, right? So I always tell buyers, real estate is temporary. If you're buying a place, you need to expect to live there for 2 years because of the tax-free gain. But it should be comfortable enough that you could live there for 5 years if you absolutely had to. I never like anyone to be so jammed in a house they're desperate to get out at the 2-year mark. You want to make sure it's something that you enjoy living in enough to where if we see that little downfall, you're not forced to sell it. Okay. Stop me if you guys have any questions so far. If not, I'll roll into the election year. I only have a little bit on it because it's kind of minor. Election year. You can see on my orange circle over here. Election years are simply distraction and uncertainty. Everybody feels distracted and uncertain about what's going to happen. And it stems from the mail. Now, there's signs and news and chaos as well, but the mail really does it to people. I don't know what it is, but you get all the election mail. And as soon as that starts in kind of like end of September, October, just now it's an election year and everybody's focus has changed. So sellers either, number one, want to sell before the election for fear of whoever they don't like getting elected and prices are going to go down and our economy is going to crash, or they just want to wait and see what happens and there's too much uncertainty and they decide not to sell. Last election was 2020. I mean, just look at how many houses were being listed. This is the new listings in 2020. We used to see, look at July 2020, 4,000 homes in a month. And remember, it was just 1,200 homes in a month. In December, it was less than 1,000 homes in a month. So our supply has gone down so much. But look at what happened in October and November and December, that election year time. December's the holidays. October, November, September's election year, and you can see our supply went down. And that's what I'm expecting. I'm expecting supply to kind of slow down and a lot of people to just like breathe October, November. So I think as a real estate agent, I think I will be very busy up until October, and then people will just want to wait until next year. And that's what we usually see in these election years. So if you want to buy a house, you should be seeing much more supply before the election rather than after. So if you're picky, you want to buy sooner. But if you're during the election, there might be less buyers, so you could possibly get a little bit of a better deal. It remains to be seen. And if you're a seller, you really want to list before the election or the year after 2025, because we're going to have the election and then we're going to have holidays, and it's going to be an extended holiday period where everyone's kind of burnt from the election and then focused on the holidays, and then people jump back in the following year. So that's kind of what I'm expecting for the end of this year, for it to be similar to 2020, but way less houses because our supply is so low. Okay, let's talk about some loan programs and grant opportunities. So I have a couple here listed out, and then I can like verbally talk about some more. I know, Gabe, we talked about the 2 to 4 units, but let's start with another real estate myth, my favorite real estate myth, the myth of 20% down payments. For some reason, everybody I talk to tells me they have to put 20% down because they just thought they had to, and that's an absolute myth. In fact, the reality is we see 0% down. I don't have it there, but we're seeing once again 3% down, 3.5% down, 5% down, 10% down, 15% down, 20% down. So there's tons of options on your down payment. You absolutely do not need to have 20% saved up if you're going to live in the house. Now, we'll talk about owner-occupied versus non-owner-occupied, but one of my favorite loans to get people started is the FHA 3.5% down. But it's a little bit tough right now, so I want to talk about some caveats on it, but we'll start with what it is. So the 3.5% down is an FHA, it's a government-backed loan. There's less strict qualifying standards. Oh, another myth is that FHA loans are only for first-time home buyers. Absolutely not true. In fact, I've had 2 FHA loans in my life. The only thing is you can only have 1 FHA loan at a time. So what I did is I bought a house with an FHA, I refinanced that loan into a conventional, then I bought a second house with an FHA, and then I refinanced that with a conventional. So actually I could get another FHA if I wanted to. The cons of FHA is that they are expensive. The interest rates are lower. You can have a lower credit score or no credit score, but there's PMI, which is called private mortgage insurance. Let's talk about what that means in case you don't know. So any loan less than 80% loan to value, so less than 20% down, requires some amount of PMI. And it's a fee for having a low down payment loan. You don't get it back, but it is tax deductible for now. That's one of the items that politicians sometimes want to take off as tax deductible, but right now it's still tax deductible. My first FHA loan was a purchase price of $665, and the PMI was $550 a month, just for like reference as to what it is. There's also a 1%, although I think it's actually 1.75% now, funding fee. So you can roll it into the loan. It's basically just a fee for an FHA mortgage on top of the purchase price. So if you buy a house for $700,000, 1% would be $7,000. So let's guess $12,000 fee on the FHA. So it's expensive. Like, why would anyone do it? The entire purchase of the FHA is to get into a property. Just get in when you have less money saved up, and then you have options. So you can use an FHA on FHA approved condos. Big caveat, not all condos are FHA approved. In fact, my buyers that want to do condo townhomes, I try to get them to 5% down so we can go conventional. FHA approved townhomes work. Single family houses work, and our favorite 2 to 4 unit properties work as well. So I've done 2 FHA loans on 2 to 4 unit properties, and it works well, except that, oh, I have it coming up here, but It's hard on fixer properties, and it's hard in multiple offers situations. So let's continue, because I know I'm going to go over on time, and I apologize. I try to keep it to an hour, but I have a lot of good info today. So my favorite grant program, I want to talk about this one. And then I'll talk about the one that everybody's heard of that I hate. So let's start with my favorite grant program. This is for low to moderate income areas of San Diego only. So it's not based on zip code. It's based on certain streets and everything. We have to hand check every single property to see if it'll qualify. And they're all over that these work, but there are income restrictions. I think it's $160,000 a year is my memory, is the maximum income. You get $10,000 towards your down payment, and you get $7,500 towards non-recurring closing costs, which is fantastic. Okay. It's a 3% down program as well, which I forgot to put in here. So you put 3% down, you get $10,000 towards the down payment. You do have to pay taxes on the $10,000. They send you a 1099, but the $7,500 is totally free money. There's no payback. They don't take a piece of your equity. And it works on houses, condos, and townhomes throughout San Diego. So I'm in escrow with a client on the grant program on a condo. Purchase price is $475,000. It's in 92115, so south of San Diego State. And I think that at the end of the day, their cash in to buy this place will be about $8,000 cash, all said and done, between down payment and closing costs, which is amazing. And it's getting them into a house. I also did one actually in La Mesa. We just came up on this one that happened to be low to moderate income. It was definitely moderate. Just walking distance from downtown La Mesa. Great little townhome. Got one of my clients in there. I think their out of pocket was under $9,000 to get in there. I think the purchase price was low fives. This was last year. So there's some really good opportunities for my first-time home buyers, because this is first-time home buyers only, that are looking for some money towards their down payment. Now, I don't have a slide on it, but I will mention that California, what's it called? Dream for All. Yeah, Dream for All down payment assistance program. It is coming back. This is the one that made a buzz last year. They give you 20%, although they take your equity, but it is what it is. It ran out of money in like a week. So they've already announced it's coming out in April. If this is something you guys are interested in, I can do like a deep dive with you, but there's a new rule that nobody knows about. It's at least one applicant must be a first generation home buyer, meaning their family's not owned a house before. So it's no longer just first time home buyers, it's first generation home buyers. And to the best of the homebuyer's knowledge, their parents, biological or adoptive, do not have any present ownership interest in a home in the United States, or their deceased parents did not have ownership in a home at the time of their death. So big change on that Dream for All program, and that's taking out a lot of people that were interested. This is my grant program that I love. I think it's way better. Some grant programs, they give you the money and then they take part of your equity. So they'll say, we'll give you 20% down, but then when you sell, we want 20% of the equity. So they take a piece of your profit, which in San Diego can be a hefty sum. So I try to guide buyers away from it. I also have a doctor and dentist loan. I always like to mention, I don't know if either of you or doctors are dentists, but I do have a great one. It's a lower down payment, and then they're less strict on your student loan debt, which is really nice for my doctors that are making good money, but still have their student loans to get into the market. Non-owner occupied loans. So if you live in a house, you can do a low down payment, but if you don't plan to live in it, now it's a non-owner occupied loan instead. These are usually 25 to 40% down and come with a higher interest rate. So we can do a conventional non-owner occupied loan. I've done plenty of them myself. You get a full underwrite when it's conventional. So you still need tax returns. pay stubs. They're qualifying you based on your income. But your interest rate is usually just a smidge higher than a primary residence loan, which is nice. The other type of investor loan is called a DSCR loan, which is a debt service coverage ratio loan. And these are investor loans. A regular person would never want to use them, but they're great for my real estate investors because they're no document loans. So they don't qualify you, they qualify the property. And this is how commercial real estate is done and has always been done, but they're bringing it into residential for our smaller scale investors, which is really nice. You really need 20% down. Occasionally, we can find a 10% DSCR, but you shouldn't count on it. Like, expect to put 20% down on DSCR. All they care about is the PITI, that's property tax, sorry, principal, interest, taxes, and insurance, and the market rent of the property. And they're looking for the ratio. So depending on the ratio dictates the interest rate. If the market rent is equal to the PITI, I think you should expect an interest rate around, I'm going to go 9 to 11% right now. And it's something like, I have a lender that's great at it. We can talk about it if it's something that anyone's interested in. But it's a great opportunity for investors who can't qualify. Maybe they live off investor income, they don't have a job, then they can't just get a loan because they have no income. Or someone like me who's self-employed as a real estate agent who has write-offs, and then like it's hard to get a loan when you're a business owner. So a DSCR loan's a way to get a loan without having to have those pay stubs. And again, this is only going to be for investment properties. Gabe, do you have other questions on this, or did I answer all of them?
No, you did. You did a great job.
Oh, thank you. Okay, cool. Okay, I do like to mention a couple things just to educate people on buyer closing costs. So let me pull them all up here. Okay, so when buyers buy houses, they need their down payment, but they also need a little bit of extra money for closing costs. So you need to make sure you have the cost for your inspection and your appraisal. Those are paid out of pocket. They're not part of the traditional closing costs. Then you also have a loan fee, a title fee, and escrow fee. Those are all our non-recurring closing costs. And on my grant program I love, you get $7,500 to offset those. And then you also need to fill your impound accounts if you're doing impound, which we'll talk about. But I usually say your closing costs are about 1%. So if you want to buy a condo, I always recommend 5% down conventional so we don't have to worry if it's an FHA approved or not. And then you need 1% for the down payment. So saving up, or sorry, 1% for the closing costs. So saving up about 6% is what's really going to get you to the point where you're able to buy a house or a condo. PITI, principal, interest, taxes, and insurance. That's the monthly payment that you should expect. Some people do just principal and interest. Some people put in the taxes and insurance on the monthly. So if you have an impound account, this is a choice that you sometimes get to make. Some loan programs force you to have an impound account, and some loan programs increase your interest rate if you don't have an impound account. So sometimes you can get out of them, sometimes you're required. With an impound account, each month you pay your regular principal and interest, plus you pay 1/12 of the annual property taxes and 1/12 of your homeowner's insurance premium every month. Your monthly payment's higher, but there's no lump sum payments for taxes and insurance. But your closing costs go up because you have to fill this impound account. So you're prepaying some property taxes and prepaying actually an entire year of insurance, and then you start paying it immediately month one. So if you end up with a surplus at the end of the year, you get it back after 1 year. You have too much money that you've paid. And FHA loans do require impound accounts. And like I said, a lot of loans require impound accounts or penalize you if you don't. What can you afford? Always start thinking about the monthly payment you can handle, as well as the amount of cash you want to spend on the down payment and closing costs. Yeah, so when I talk to buyers and they're like, I don't know what I can afford, I always start to say, well, what cash do you have? Because a lot of people are limited on cash as opposed to what their income qualifies them for. Um, and a lot of times buyers are able to qualify for monthly payments that are more than they want to spend, because when a lender looks at your income, they're looking at your pre-tax income. So they'll say outrageous numbers like, oh, you guys make like 17,000 a month. Like I had, that for a recent client, and my clients are like, oh, no, we don't. Like, have you seen our taxes? So they qualify it based on that pre-tax amount, which means they'll give you a lot more money than you can probably, handle to pay back each month. At the end of the day, you need to have a one-on-one conversation with a bank or a broker to discuss what you can actually afford. I always like to mention the differences between them. So a banker works for the bank, and they can only use their bank's products. Banks' rates fluctuate depending on if they want mortgages or not. People don't know that. So sometimes Wells Fargo doesn't want mortgages, so they jack the rates up or don't offer some types of loans. Yeah, the last investment property I bought in 2022, when rates were going up, nobody wanted to do the loan I needed except actually Wells Fargo. And so I had no choice but to go with Wells Fargo because all the other banks just got rid of that loan program. The alternative is to go to a loan broker. And a loan broker has products from all the different banks and other wholesale mortgages. So they can shop around for you and say, Chase is looking better, Bank of America is looking better, whatever it is. Usually I have people say, I have a loan broker I love, so I have them talk to my loan broker. But then I also say, if you have assets with a bank, you should always talk to them, because for my high earners and high savers, if you are private client status or something like that, your bank is going to give you a really nice interest rate that a loan broker may not be able to match. So it's always important to talk to the bank where you hold money as well. Pre-qualification, pre-approval, pre-underwritten, we'll jot through this real quick. I don't need to go too deep on this Zoom here, but a pre-qualification is going to be your weakest. Basically, a pre-qualification means you had a phone call with the lender and you told them what your income is and they told you what you could probably afford. A pre-approval is the one you need to get started. So a loan officer has received and reviewed your documents and has given you a maximum purchase price at a certain interest rate. And once you have that pre-approval, which takes 1 to 7 days, I would say, once you have that, you're good to go shopping for a house. Pre-underwritten usually happens after you're pre-approved, and that's where they send all your paperwork to the underwriter and go through and see what else they're going to need. And we can keep adding conditions until you really just need the property address and your loan's mostly done. And as the market gets more and more competitive, being pre-underwritten is super important, because you can, if you're pre-qualified, you need 30 days to close. If you're pre-approved, you need 21 days to close. And if you're pre-underwritten, you can close in 15 days or less. And so if you need to close quicker in order to get the house and beat out other buyers in a multiple offer situation, being pre-underwritten is super critical. Let's move on to bidding wars, if you guys are cool and ready. Okay, let's do it. Should you expect a bidding war in 2024? Oh my gosh, yes. You should expect a bidding war in 2024. There may not always be a bidding war. They might not always get crazy, but I am expecting most properties to be receiving multiple offers in 2024. Oh, this house, my clients didn't get it. It had 42 offers. And it's very sad because my clients came in second. They are 5% down borrowers, and we got beaten out by all cash, no contingencies. And it's just so sad because I'm so happy we came in second. But in real estate, if you're not first, you're last. So we didn't get the house, sadly, but we did beat out 41 other people, no, 40 other people, which is, cool for me, sad at the end of the day. So what do we do in multiple offer situations? I always like to mention, because I do represent buyers and sellers. So my business is about 60% buyers and about 40% sellers. And I have sat at a table with sellers trying to decide on what offer to take. So what happens is when there's multiple offers, like I don't even know how you handle 42 offers. You have to sit down at the kitchen table, sellers and their agent. The agents usually make a summary spreadsheet and then have like 1,000 pieces of paper of all the offers printed out as they're trying to pick someone. So the questions we have to ask ourselves in this are, how can you stand out in the stack? And how can sellers even decide which offer to accept? They just, at a certain point, have to just start throwing offers in the trash for any reason at all, because there's too many to handle. So here are some factors sellers consider when comparing multiple offers. I like to go through the obvious. The price is like the most obvious, we all know. At the end of the day, like half the offers are going to get thrown in the trash because they're just too low on price. And as a real estate agent, as a buyer's agent, I need to figure out where offers are coming in at so my buyers can be in the stack that stays at the top. Aside from the price, you can win with other types of terms. So the next most important one is days to close escrow. That's why I mentioned that if you're pre-underwritten, you can close in 15 days. And sometimes you need to be able to close in 15 days to compete. And so being able to do that puts you to the top of the stack for sellers that want to close quickly. Contingencies and contingency periods are another one that's super important. So I talk to my clients about removing their loan contingency if they're pre-underwritten. You kind of don't need one. Your loan's pretty much guaranteed, right? Removing the appraisal contingency, that one gets crazy. That's something we can talk about one-on-one, when the time comes, if it's necessary. And then we write down contingency periods. And I have a couple little tricks I do as well to write the most clean offers I can. The type of financing. That's one of the cons of FHA is if there's this huge stack of papers, a seller could just say, here's the FHA ones, I'm going to throw them in the trash because they don't know what else to do. There's so many, they have to start choosing somehow. How far along the loan is as well, is it pre-qualified, pre-approved, pre-underwritten? Any pre-qualified, they're going to throw those in the trash. Everything needs to be pre-approved or pre-underwritten. And then we do have buyer love letters. They're not always allowed, but when they are allowed, it's another thing that can be used to say, like, these people wrote a letter, these people didn't. But, it just kind of depends. And I'll show you some other stuff we can do. So the less obvious, your down payment amount. Even if you're conventional, if you're 5% down versus 20% down, sometimes sellers just eliminate you because you're low down payment, because they have nothing else to go off of. And that doesn't always happen. At the end of the day, like I said, we beat out 42 offers and 40 other offers, and a bunch of them were cash, and we beat them out on price. And we still had really good terms. We had no appraisal contingency. We went as hard as we could, knowing our 5% down loan is what's holding us back because we're not cash. And so you have to outweigh everything else when you have something working against you. There's random other terms. I just bought a house and I got the house for a couple of reasons, but I wasn't the highest offer. But one of the reasons I got it is because I offered to pay for and install the smoke detectors in the house, which is ridiculous because it's like I have a smoke detector in my trunk of my car as a real estate agent, but the listing agent and the sellers were in Orange County and they truly didn't want to drive down to install a smoke detector. And so they picked my offer. Crazy. Termite or no termite. This is one where an experienced agent versus a rookie agent. Termite requests don't belong in offer paperwork. And if an agent puts it in there, then they could just get eliminated simply because they put it in the wrong document. Buyer agent influence. This is my favorite one as a buyer's agent. I am selling my clients from day one. Like, I am so professional when I reach out to agents. I always make sure my name and license number are in text messages. I'm very polite when I request showings. I'm, try to be on time to best of my ability, text people with what we think. let them know we're writing an offer, give them a call, become their best friends. And that's really important, just to show that I'm a real estate agent that knows what I'm doing and professional. And that leads to seller agent influence. The dirty little secret is the selling agent picks, the listing agent, the one that represents the seller. At the end of the day, they kind of pick the offer, because when there's all these papers, sellers look at their agent and say, what should we do? Like, what do you think we should do? And so the selling agent's going to be like, well, I didn't like this agent. So I'm like, but I liked this one. So let's put them towards the top. Or I met these buyers and they seemed legit. Or these people wrote an offer or wrote a letter, so they probably really like it. Or their lender called me and the loan looks great. Whatever it is, that little influence of the agents is extremely important in multiple offer situations. And then the one that shocks me that I even need to mention is for rookie agents, how clean the offer is. Did they put weird extra terms that don't belong there? Did they make typos? Is their wording bad? Like, I've taken offers and thrown them in the trash because they have sentences that are written meaning nothing, or meaning like stuff that I'm like, that's weird. Why would we get involved in that? So poorly written offers can just eliminate you as a buyer. And that's what's sad about the industry. I don't need to harp on it too much, but what's sad about those 40 buyers on that house that lost out, some of them never even had a chance because of their buyer's agent, which is very sad. So here's some strategies when writing offers, when we have multiple offers. Your buyer's agent should always speak with the seller's agent and sell themselves and the buyer. It's massively important. Your buyer's agent needs to find out exactly what the seller wants, and your offer needs to give it to them if you want to stand out. So if the seller wants to close as fast as possible, your close needs to be as fast as possible. If the seller needs time to move out, then you need a longer escrow or a rent back. You want to give the best possible terms on all our contingency periods. You want to shorten it. If the seller's like elderly, you want to shorten the number of days you can take your contractors and be in the house. That's a weird term you can do. You can tweak some irrelevant terms to look better and stand out in the crowd. So I have a couple little things I do that I'll tweak. The smoke detectors is a great example of, like, it's nonsense, but like you might as well tweak it. And the loan officer should always call the seller's agent and sell the loan as well if there's a loan, just so they have something to tell the sellers. Like, hey, I actually talked to that loan officer. She was super nice. Their loan looks really good. At the end of the day, price is really the only thing that matters. If you are significantly below the other offers, they're not going to take your offer. That's the bottom line. But if it's close, that's when all of these other terms are really important. Cash offers, conventional loans, low down payment loans, grant program loans, VA 0% down loans, FHA 3.5% down loans. It's all the same for the sellers. At the end of the day, the sellers get cash in hand, whether there's a loan or not. People don't always realize that. So, does cash always win? No, cash does not always win. Let's talk about some caveats, though, on this. So, yes, cash is cash, right? If it's an FHA, they get cash. If it's a VA, they get cash. But here's some things they're looking for. FHA and VA loans have a different type of appraisal, so they're almost always less desirable than conventional financing. You can see on my gray second one. Conventional appraisers are looking for the value of the property plus 3 things: smoke detectors, carbon monoxide detector, and water heater bracing. But when you look at FHA and VA, they're looking for habitability. They're looking to make sure there's hot water, there's no peeling paint and stuff like that. So on a fixer house, an FHA is way weaker than a conventional or cash at the same price because of the condition of the property. So on my FHA buyers, I sometimes have to get them pre-approved for FHA and conventional, because if we're in a multiple offer situation, the FHA is never going to work on a fixer. You have to go conventional, because they'll just throw your FHA in the trash as a distinguishing factor. Cash offers, why are they an advantage? They have no appraisal. There's no loan, there's no appraisal. So they're not looking for habitability. They're not looking for smoke detectors, carbon dioxide, any of that. They're not looking for what the true value is. They aren't taking the time to have an appraisal so they can close quicker. So that's the huge advantage to cash buyers. But buyers with loans can beat a cash offer simply by paying more because at the end of the day, the sellers get the money and they want the most money. I'll do a quick thing on escalation clauses. Escalation clauses suck in California. We do not have an escalation clause form. We don't have a little escalation clause section. So we have to write a sentence in. And if you write it badly, they might not take it. So the issue is when multiple buyers write an escalation clause, we get into a stalemate. If two people are like, I'll pay 5,000 over the highest offer with the like up to 750 or whatever it is, then which one do you pick? You know, like you're in a stalemate. So in those situations, these multiple offer situations, listing agents often don't allow escalation clauses or they counter them out in multiple offers. So some agents, buyers like rely on escalation clauses to ensure they get the house. And you shouldn't do that. You should be able, as a buyer's agent, to be able to get a house without needing an escalation clause. But if you're the only escalation clause, they do work. They show you really want the house and they give that little extra hedge. So it's a case by case basis, a house by house basis. You have to call and be like, can I do an escalation clause? Yes or no? And then my very quick buying with an eye on refinancing. I know we're going over, guys, so I'll go through this and I can answer everybody's questions. A refinance, you do an entirely new mortgage. You throw out your old mortgage and get a whole new one. When should you refinance? When interest rates have gone down is the obvious one. When you want to get rid of your PMI. Remember how I said on FHA loans, there's a high PMI? The other issue with that FHA PMI is you have to refi out of it. It never drops off. So if you're getting an FHA loan, you should be prepared to refinance and you should be purchasing and using that FHA loan as a tool to get you to the refinance. And then the other time you should refinance is you have so much equity that you want to cash out. So you can do a cash out refi and increase your loan amount and take the difference out in tax-free cash. So I did this like in 2020 myself. I had a loan amount, I would say around 600,000, and I refied it up to 700,000. They gave me 100 grand tax-free, and then I went out and bought investment properties and used that as my down payment on 2 properties, out-of-state investment properties. And so I was able to take the cash tax-free, leverage that into other properties, and this is another rental that my tenants, I increased their rent when a new tenant moved in. And so it covered that extra cost of me taking out 100 grand, which is cool. So it's another option that you have once you own real estate. Another refinance in mind is my 90-10 method. So this is for my clients that saved up 20%, but they want to get a fixer. And I say, okay, instead of putting 20% down, let's buy it with 10% down. Then take your other 10% and use that for the remodel. Wait a year for rates to go down and prices to go up, and then refinance into that 20% equity, drop your PMI, drop your payment, because you have equity from the market going up, but you also have equity from increasing the value of the property with a remodel. And I love this strategy. It's something I talk through with a lot of clients to see if it makes sense. I also have a team that does remodels, especially cosmetic ones. If we're just doing like new kitchen, new bathroom, new floors, and not anything structural, it works great. You know, putting in all the cute stuff really increases value. Get that next appraisal, you know, refi into a lower payment. And then a real estate saying, date the rate and marry the price. So it's an argument for buying before prices go up anymore. As rates come down, you can always refinance. Many lenders are offering low or no cost refis for my clients that are buying now. But your property taxes are based on the purchase price. So if you lock in that lower price, that means lower taxes until you sell. We're not reassessed in California. So getting in on that lower price keeps your expenses lower. But you can always refi, right? So that's the argument of buying right now, is saying, hey, I think prices are going to go up over the course of the year. I'm going to try to buy now. So at the end of the year, I'll have equity from prices going up and the rates should be lower. And then I can do a refinance. And that's a really good strategy for a lot of people. And that is the end of my presentation for today. So I apologize for going a little bit over. We're about 20 minutes over, but I have time for questions if you guys have anything for me.
I do have one question.
Yes, go ahead.
By the way, we've been listening the whole time. It's just a little loud here. So actually two questions. What area in San Diego would you recommend that we buy in? Maybe like a 3-bedroom, 2-bath. I was looking into like El Cajon area. Let me know what you think about that area. And then also you mentioned the banks. Which bank do you recommend that we go with?
Okay, great questions. So first of all, I think we should do a one-on-one call to talk a little bit deeper about what your specific goals are. But what I'll tell you on the area is, one of the things I do with my clients is I look at zip code appreciation data. And if you look at like 92115 and Chula Vista, over the last 10 years, they've gone up substantially. If you look at like a City Heights, they're a little bit lower down, a little bit flatter. So I always like to say, let's see the areas you can afford to get the house you want. And then let's try to get you in a zip code that's been going up. So you probably will have really good appreciation as you own it as well. Some of my favorite areas, you mentioned El Cajon. I love Fletcher Hills. I love San Carlos. We've seen great appreciation in San Carlos. Chula Vista around the downtown area it's hard to get a house right now, but there's been great appreciation there. Depending on your walkability, we all know North Park, South Park, Normal Heights, all of that's very popular. I'm seeing prices go up in Carlsbad a lot more. There's some really nice areas of Vista and Oceanside as well. So there's a lot of good options, depending on what your goals are. And then I work with a loan broker. Her name's Margaret. She's fantastic. She does my loans in California and loans for a lot of my clients. I don't get anything for referring people to her. She's referral only. So she doesn't sell people. She helps people. And I love that because she's semi-retired and isn't here for the money. She's here to help people. So she gives really like straightforward and honest advice, which is what I try to do as well. So if you're interested, I can send you over her contact info. And like I said, she's fantastic.
Yeah, we could definitely have that 101 at a different time, but thank you for answering that question. And then just a bank, is there a specific bank that you recommend?
Not off the top of my head. Like I said, it varies month to month on what banks are doing what. So I have not looked at the bank loans lately for what's going on. And then like the grant program I have, that's at a specific bank. So that's the one that I send people to a bank. Usually I send people to a broker over a bank to make it easier.
Thank you.
Yeah.
I had a question about creative financing. Are you seeing any seller financing or sub twos or anything of those sorts, or is there just so much competition with regular potential buyers that that's not even a thing?
So we have seen some of it. It's phasing out a little bit because of the competition and people don't need to offer it. I have occasionally seen some seller financing. A lot of times they want big down payments. They'll carry with like 50% down and stuff like that. We see it way more in commercial because it's just commonplace. So when you're getting into commercial, you will see like a mixed loan where someone does 70% loan to value, plus they'll have the seller finance like 10 to 20%, and then they'll bring in cash for the rest. And that's pretty popular, but on just residential properties, they're few and far between. A lot of times they're either at an interest rate that makes you laugh or a down payment that makes you laugh. Subject to, I haven't seen a subject to in a while. Yeah. And I haven't seen foreclosures and stuff like that either. we're not, yeah. I try to tell people like in the nicest way possible, there's really no deals in San Diego. Like I get regular people are like, oh, like I'm looking for a deal. And I'm like, you and everybody else. But there are deals in terms of it's the deal for you where you're like, this is that you have the vision, you know what you're going to do with the property. It makes sense. You know, you can do a remodel, you can build an ADU, and you're like, this is a property that's going to match my specs. So it's a deal for me. But saying objectively, like, I want to buy a house 20% below market value, like, yeah, that'd be great. I would too. Yeah.
No, that's awesome. Thanks for the just a really, really great presentation. You know your stuff. Like, we'll definitely have to do a one-on-one call.
Yes, 100%. So I'll send both of you guys an email with my Calendly link. And then that way you guys can reach out. Gabe, did you register through Eventbrite?
Possibly, yes.
Okay, cool. So then I should have your email. If not, I think you're on Instagram with me, right? Weren't we talking on Instagram the other day? Yeah. So I'll send you guys both my Calendly and my contact info. You guys can schedule a one-on-one call with me anytime that makes sense, and we can chat through like your goals, what you're looking for, how I can help. My entire goal and my like dream is to just help people get into houses. It makes my heart so happy when I have buyers that didn't think they could get a house and get one and make money off of it. And I just want to help people build their wealth as well. So anything I can do for you guys, I would absolutely love to help you and get you pointed in the right direction.
Thank you.
Go ahead, Steven.
Oh no, I was just saying thank you for the presentation.
No problem. Okay, I'm so glad you guys enjoyed it. I hope we covered the stuff you were hoping for. Let me know if you guys think of anything else. I'll reach out with contact info. Do you guys want me to send you a link to the recording as well to rewatch?
Yeah, that works for me.
Okay, cool. All right, I'll get this recording uploaded somewhere. I'll send it over to you guys with my Calendly, and I'd love to do a one-on-one call and talk more with both of you. All right, guys, have a good night. Thank you so much for joining.
Bye.
Bye.